Assalamualaikum. Today, I will be presenting about Malaysian Government Securities or MGS for short. This presentation will explain what MGS are, why the government issues them, and why they are important to the Malaysian economy. So, what is Malaysia Government Securities or MGS? Malaysia Government Securities are long-term bonds issued by the Malaysian government through Bank Negara Malaysia. These bonds are offered to investors as a way for the government to raise funds. When invested by MBS, they are basically lending money to the government. In return, the government promised to pay them interest every 6 months until the bond reach maturity. This is known as a coupon. Since MGS are guaranteed by the government, they are considered low risk and very stable. The maturity period for MGS usually ranges from 3 to 30 years, depending on the bond. So, the purpose of issuing MGS. The main reason the government issues MGS is to raise money for national spending. This include building infrastructure like roads, schools, and hospitals. MGLs also help the government cover budget deficits. That means when government spending is higher than its income. Instead of increasing taxes and right away, the government can borrow through MGS and pay it back gradually. This also helps ensure the country continues to grow and develop without putting too much pressure on taxpayers. MGLs are also used to manage public debt and support economic stability. So for now, is importance of MGS in the economy. MGS play an important role in Malaysian financial system. First, they are a safe investment for large institutions like pension funds, banks, and insurance company. Second, MGS act as a benchmark. This means that they help set a standard interest rate for other loans and bonds in the country. BNM or Bank Negara Malaysia also use MGS as a tool for monetary policy by buying or selling these bonds. The central bank can control the amount of money in circulation. This helps manage inflation and keep the company stable. So, in short, MGS are not just government debt, they are also essential tools for economic planning and stability. The purpose of this assignment is to help us understand how Malaysia handles its financial responsibilities. By studying MGS, we learn how government borrowing works, how public investment are funded, and how investors can earn from bonds. This knowledge is very important, especially for those of us studying finance, business, or economics. It also improves our financial literacy and give us a better idea of how the government manage money in a responsible and sustainable way.
Okay, so I'm going to explain about the characteristics of MGS. First one is fixed rate and coupon payments. MGS are fixed rate coupon securities, meaning the interest rate remains constant throughout the life of the bond. These bonds feature bullet repayment where the principal is repaid at face value upon maturity and interest is paid every 6 months. Second one is callable option. Certain MGS are callable, allowing the government to redeem the bonds at par value with 5 business days notice to bondholders. This feature adds flexibility in managing government debt obligations. The third one is yield to maturity. The yield to maturity is the actual return an investors earns if the bond is held until maturity. At issuance, the coupon rate is set based on the average of successful bids and the bond is awarded to the lowest yield offered by successful bidders. And the fourth one is liquidity and reopening. MGS are highly liquid instruments actively traded in the secondary market with average daily volumes ranging between RM 100 million and 500 million ringgit. To ensure sufficient liquidity, benchmark MGS may be reopened to increase their outstanding size. And so for the last one is investor rights and risk profile. Although MGS holders have no voting rights in government or corporate affairs, they benefit from priority claims on government assets and revenue. As government guarantee instruments, MGS are viewed as low risk investment offering stable returns, making them ideal for portfolio diversification.
Roles of market participant. Firstly is issuer, Government of Malaysia. The Malaysian government acts as the primary issuer of MGS to raise capital needed is for national economic development. The issuance of MGS also helps the government manage its fiscal deficit and maintain a sustainable national budget. Secondly is Bank Negara Malaysia (BNM). BNM plays a key role in maintaining financial stability by setting monetary policy, managing interest rate and guiding the yield curve development. It also oversees transparency, provides market infrastructure like the real-time electronic transfer of funds and security system or rentas, and promoting investor confidence. And lastly is commercial bank. Commercial bank hold MGS for two main purposes. Firstly, liquidity management and regulatory compliance. Banks' consistent participation in both primary and secondary markets supports markets functioning and policy transmission.
So here I'm gonna explain about trading instrument of MTS. Which consists of two trading market, which is primary market and secondary market. Primary market issued via competitive auction to primary dealers or private placement. Bidders compete based on year, so lowest yield wins, and allocation based on auction results. And for the secondary market, MGS are freely tradable between investors, and prices fluctuate based on two conditions, which is demand and supply and interest rate movements. So we move to the how MGS trading works. So MGS trading works by annual auction calendar, issuance schedule announced at year end. uh, Issuance sizes are in 1 to 4.5 billion ringgit, announced a week before auction. Benchmark tenors 3, 5, 7, 10, 15, and 20 years. Reopenings to enhance liquidity by enlarging existing issuers. And standard trading terms, uh, 10 million ringgit per lot. T for two settlement, price codes to two decimal points, no stamp duty or commission. So price and yield MGS. Um, the price of MGS is affected by interest rate. So when the market interest rate decreases, MGS price will increase and investor will sell for gain. It is different when market interest rate increase. MGS price will decrease and investor can buy a bond at the price that lower than its face value, which is 100 ringgit. So here we can see participants in the MGS and the role. Participant one is government, which is a BNM, issuer, primary market. Uh, Number two, we have banks and funds, which is buyers and traders or primary market. And number three, we have individual investors, which is uh, secondary market. And the last one, Bank Negara Malaysia, BNM, part of monetary policy. So, in summary, Malaysian government security (MGS) can be traded in the secondary market, where their prices and yields change based on market condition when interest rates fall. Bond prices rise, allowing investors to sell for gain. When interest rates rise, investors can buy at a discount and still receive the full value at maturity. These trading activities help investors manage returns and risk while ensuring liquidity in the bond market.
So let's talk about benefit to the insurer for selling Malaysian government security. First, rising fund from the domestic capital market. By ensuring Malaysian government security, the government avoid relying on external borrowing. It reduces exposure to foreign exchange risk and maintain control over its debt strategy. Second, financing development and operating expenditure. The funds are used for infrastructure projects, public services, and daily operation. It helping maintain economic stability and prevent financial crisis. Third, continues insured during fiscal surplus. During the 1993 until 1997 fiscal surplus, Malaysian government security will still ensure to promote a stable, equitable market and develop a benchmark yield curve for debt pricing. Last but not least, meeting the investment needs of institutional investors. Institutions like EPF, local bank, and insurance company invest in Malaysian government security due to its stability. It's ensuring strong demand and reducing the government financing risk.
Benefits to the investors for investing in Malaysian government securities. First, highly secure and stable investment. MGS are backed by the government and offer fixed interest payments every 6 months. The full investment is returned at the end, making it safe and stable option. Second, steady and reliable income stream. MGS pay interest twice a year at a fixed rate, giving investors a reliable and regular income throughout the investment period. Third, capital protection. Your full investment is returned in one lump sum when the bond matures. This helps protect your capital if you hold it to the end. Fourth, tax-free investment returns. The interest and profit from MGS are not taxed. This helps investors keep more of their earnings, especially those with bigger portfolio.
Conclusions: MGS Malaysia government security are safe, low-risk investments backed by the government. They give fixed returns and are easy to buy and sell. They help the government raise money and give investors steady income. Even though we had some trouble finding data, this assignment helped us understand how important MGS is for Malaysia's economy.